gold is a 5,000-year-old brand. I think it's more than that, but okay, 5,000 years. Bitcoin is a 10-year brand now. And he said, maybe I should own some. Maybe I should own some because it's performing the same role as gold. It's going to maintain its value because it's scarce, just like gold is scarce. Gold is scarce. The supply of it grows about 1% per year on average over a very long period of time. When the price spikes, that percentage will go up because people have more incentive to mine for more gold. Well, something is going to happen this year with Bitcoin, which means that its supply growth is going to drop below the supply growth of gold. It has been growing 1.8% per year, the number of Bitcoin out there, for the last 4 years. In April, it's going to go through what's called the halving, halving, halving. That growth rate will be cut in half to about 0.9% for the first time, falling below gold.
Cathie Wood discusses the changing perception of Bitcoin as an investment asset, drawing parallels to gold and emphasizing its potential as a store of value. She mentions Stanley Druckenmiller, a well-known investor recognized for his perspectives on innovation and valuation, who acknowledges Bitcoin's emergence as a significant asset class despite his traditional stance. She compares Bitcoin to gold, highlighting its scarcity and the preservation of value over time due to limited supply, which increases by approximately 1% annually. However, Wood brings attention to a significant upcoming event for Bitcoin called the halving, which takes place roughly every 4 years and reduces the rate at which new Bitcoins are created, effectively cutting the supply growth rate in half. This halving event, scheduled for April, will lower Bitcoin's supply growth rate to approximately 0.9%, surpassing that of gold for the first time. Wood underscores the scarcity of Bitcoin, which differs fundamentally from gold. While gold's scarcity stems from its physical rarity and the challenges of mining, Bitcoin's scarcity is mathematically enforced through its protocol. She clarifies that the total number of Bitcoins that will ever exist is limited to 21 million, with around 19.5 million Bitcoins already in circulation at the time of the discussion. Wood highlights the concept of strong hands among Bitcoin holders, referring to those who have held onto their Bitcoins without moving them for an extended period, symbolizing a long-term commitment to the asset. She mentions that a significant portion of Bitcoins, approximately 15 million, are held by such strong hands, indicating a resilient and dedicated investor base that firmly believes in the long-term potential of Bitcoin. Moreover, Wood explains the recent surge of interest from institutions towards Bitcoin, which is further emphasized by regulatory advancements like the approval of Bitcoin exchange-traded funds, ETFs, by the Securities and Exchange Commission, SEC. Wood's company was one of the 11 that introduced Bitcoin ETFs, showcasing the confidence institutions have in this asset class. She suggests that this institutional involvement could result in a surge in demand for Bitcoin, potentially driving prices higher. However, Wood also acknowledges the challenge institutions may face in convincing long-term Bitcoin holders, known as holders, to sell their holdings. This observation reflects her belief in the steadfastness of Bitcoin's dedicated investor base and the potential clash between institutional demand and the sentiment of long-term holders. Overall, Wood's analysis sheds light on Bitcoin's increasing prominence as a viable investment asset and the intricacies surrounding its ever-evolving market dynamics.
The seeds for everything that is happening today were planted in the 20 years that ended in the tech and telecom bubble, right? And then there was the crash. So all the seeds were planted there. But the reason the crash happened is because the technologies were not ready. And even if they were kind of getting ready, the costs were prohibitive. So just to give you a good example of the second one, in 2003, but we were thinking about it in the late 90s. In 2003, the first whole genome was sequenced. We were able to understand all of the 6 billion bits of code in one person's body, so that we could understand what was going wrong. That cost $2.7 billion just for one person. and it took 13 years of computing power. We were not ready for prime time, but biotech was a big part of that bubble, right? The technologies weren't ready. We didn't get the cloud until 2006. We didn't have the two very big breakthroughs in AI, deep learning in 2012, and then transformer architecture in 2017-18. Those technologies were not ready for prime time back then, but capital flowed aggressively into them and shouldn't have. Today they are ready for prime time. We are starting to scale the 5 major platforms, which are robotics, energy storage, artificial intelligence, blockchain technology, and multi-omic sequencing in the life sciences space. And I know, Andre, you have a big interest in the healthcare space, and that's probably going to be one of the most the sectors most transformed by these technologies. So we believe they're scaling now, but and this is perfect investor psychology, and I'm very comfortable. People are scared. I'm comfortable as a portfolio manager because I would prefer to be investing in something controversial when there's a lot of FUD out there, fear, uncertainty, and doubt. And that's because there's people fearing for their jobs, their businesses, meaning in the financial industry, and they don't want to be wrong. Well, guess what? If you don't take risks, you're not going to get returns. But you have to manage those risks and manage around the volatility. Use it to your benefit.
Cathie Wood discusses the origins of the remarkable technological progress we are currently witnessing. She traces back these advancements to the period between the late 1990s and early 2000s. Wood highlights that although the seeds for these innovations were sown during that time, the technology itself was not yet fully developed to support widespread adoption. To illustrate this, Wood points to the example of genome sequencing. She mentions that while the first human genome was sequenced in 2003, the process was incredibly expensive, costing a staggering $2.7 billion and requiring 13 years of computing power for just one person's genome. Similarly, breakthroughs in areas like cloud computing and artificial intelligence, AI, didn't occur until later, with significant advancements in deep learning in 2012 and transformer architecture in 2017 to 2018. Despite the excitement surrounding these technologies, they were not yet prepared for mainstream use. Wood then emphasizes the current level of preparedness for these technologies, highlighting that they have reached a point where they can be effectively expanded. She identifies 5 key platforms that are driving this expansion: robotics, energy storage, artificial intelligence, blockchain technology, and multi-omic sequencing in the life sciences. Wood predicts that the healthcare sector, specifically, will experience substantial changes as a result of these technologies. However, she acknowledges that investor psychology is often influenced by fear and uncertainty, especially when faced with disruptive innovations. As a portfolio manager, Wood expresses confidence in investing in controversial areas during times of widespread fear, uncertainty, and doubt, FUD, among investors. She believes that taking calculated risks in such environments can lead to significant returns, as long as risks are effectively managed and volatility is utilized to benefit investment strategies. This perspective reflects Wood's belief in the transformative potential of disruptive technologies and her willingness to navigate market uncertainties to seize investment opportunities.
Disruptive innovation is going to transform the world as we know it today completely in the next 5 to 10 years. I think most investors are not equipped to do what you're doing, number one. And one of the reasons is because after the tech and telecom bust, that was in the early 2000s, and then even more so after the global financial crisis in 08, 09, they became scared. I'm going back to that. And they began to think, okay, I have to invest in the public markets. I have to invest close to the S&P 500 or close to the NASDAQ or close to the MSCI World. And so their reaction time, that skill set that I learned when there were no computers and no cell phones and no spreadsheets unless we did them by hand, the reaction time that I have to information, which is constant, it's constantly bombarding us, right? A little bit like you on the court.
Yes.
Although I could never be like, I don't know if the milliseconds that I take things in matches yours, but I think we'd make a great team. So
For sure.
Anyway, you take all of that information in, and you need to make decisions quickly. The traditional world is losing that talent because it's letting an index lead the way. Indexes are all about what has already happened. The stocks at the top of those indexes are there because of their past success. But if we're right on disruptive innovation, that, again, is going to turn sectors upside down, inside out, people aren't going to recognize them in 5 to 10 years, that is exactly the wrong way to invest. So taking information in real time, constantly, every day. If you're in the crypto world, or we'll call it more the digital asset world, it's 24/7 now. So, right, it's not just 9:30 to 4 like the equity markets open. It's 24/7. So now that world is on steroids in terms of this reaction time.
Cathie Wood discusses the significance of adapting swiftly to market changes and embracing disruptive innovation in investment strategies. She praises the person she's conversing with for their ability to assess the situation effectively, whether in finance or any other domain. Wood highlights the transformative power of disruptive innovation, foreseeing a complete overhaul of the world in the next 5 to 10 years. Nevertheless, she points out that many investors are not prepared to navigate this new landscape due to a fear-induced shift towards traditional indices like the S&P 500 or NASDAQ, especially after previous market downturns such as the tech and telecom crash of the early 2000s and the global financial crisis of 2008 to 2009. Wood credits her quick decision-making skills to her experience before the era of modern technology, when analysis was done manually without the help of computers or cell phones. She compares her rapid response time to an athlete on the field, suggesting that both require quick assessment and reaction to changing circumstances. Wood cautions against relying solely on past performance, as indicated by traditional market indices, stating that disruptive innovation will transform many sectors beyond recognition in the next decade. She underscores the importance of continuously gathering and processing real-time information, especially in the fast-paced world of digital assets, where markets are active 24/7. By recognizing the value of timely decision-making and embracing disruptive innovation, Wood advocates for an innovative investment approach beyond conventional market practices. A Bitcoin update to you all. In just a week, the price of Bitcoin has skyrocketed by 9%, reaching an impressive $66,921. Even in the past 24 hours, it has seen a 1.5% increase. Surprisingly, despite a significant 30% decline in trading volume, the market remains resilient. This raises concerns about potential manipulation by large holders, adding an element of risk. Although the price is still within the supply zone from November 2021, recent candlestick patterns indicate a possible upward extension. If Bitcoin manages to break above the $69,000 mark, we could witness even greater gains and a bullish breakout. However, if it fails to breach the supply zone, a pullback towards the $60,784 support level might be on the horizon. Thank you for joining us today as we explored the insightful discussions of Cathie Wood, from disruptive innovation to Bitcoin ETFs. If you found this video informative, don't forget to like, share, and subscribe for more content on cutting-edge investment trends and strategies. Feel free to leave your thoughts and comments below. We'd love to hear from you. Thanks for watching.